Kevin, who is at CUNY, Ariel, Mingji, and Miaojie. So Ariel is an assistant professor at George Washington University, and Mingji and Miaojie are both at Peking University. So, so the kind of, just to motivate what we're trying to do here is that, well, if you look at, one of the biggest changes in what's happening in international trade in the last few decades has been this China's ascension to the WTO. Once China joins the WTO, what you really see is that their exports really take off, right? So there's this big increase in exporting both to the US, but also to other parts of the world. And that's kind of really changed this kind of the infrastructure of what's going on around the world in both developing and developed countries, right? But at the same time, if you look at the US higher education sector, what you really see is that a few years after China is joining the WTO, there's been this kind of huge increase in international student flows from China to US universities, right? So this is both, this picture is both graduate and undergraduate students. There's been, starting around 2005, there's been this huge increase in international students in US higher education. So what we are kind of going to try to claim today is that these two pictures are actually quite related. That what happened with Chinese export growth is actually pretty related to what, and this has been basically one of the big drivers of this kind of international student flows from China to the US. So I'll tell you why we think that is. But one thing about this picture is that what you really see here is that there's been this big increase in international students coming to the US, but almost all of it has been China, right? So you don't see a similar type of response really in India. India, there's kind of an increase here, but these are the top four countries, really, the big four senders. South Korea, if anything, it's actually been going down after 2005. Saudi Arabia, there was the King Abdullah scholarship made it go up in the late 2000s, but then once scholarship was discontinued, it started going down as well, right? So there's been, the kind of the big increase in international student flows has been driven by China, and that really suggests that a major part of the increase in international student enrollment is not simply driven by demand side factors in the US. So it's not simply that US universities are demanding more international students. Now they are demanding more international students, but that's not the entirety of the story. The fact that if they were just demanding international students, then you would see that you would expect to see maybe similar increases from other countries. So there's something happening on China's side that's kind of a big part of the story. And then the other reason why you can try to... Sorry,
how do these two pictures compare in dollars rather than bodies versus dollars?
That's a pretty good question. Let me actually see if I can scroll down all the way to an appendix picture that actually tries to compare dollars to dollars. The question that you're kind of asking, so again, this is more bodies to dollars, but we'll come back to the dollars to dollars comparison to the towards the end of the presentation, where we talk about these elasticities between export surplus and goods deficits in the US. That's
definitely in dollars.
Right. So that story, to come up with that elasticity, we need to build it up a bit. So, but that's essentially one of the objectives of this paper, is to see for every import in the US, from China, what for every $1 imported means now China has, an export goods surplus of $1. For every $1 that the US imports from China, how many dollars does it export in higher education services to China? Mm-hmm. So that elasticity is something that we are essentially going to try to estimate. Sorry, this is ugly to just scroll through all slides, but that's one of the objectives in terms of dollars to dollars, like and once we calculate that elasticity, it's quite powerful because then it can tell us, well, what happens if you have these trade wars that are going on right now, right? The trade wars that started the last couple of years, there's been a bit of a flattening out, but we don't know if that's all of that is because of trade wars. But if you kind of stopped, if you kind of hurt Chinese export growth, what would it really mean for US universities, right? And for that, we need to do the dollars to dollars comparison. But it's a great question. So coming back to this thing of supply versus demand, so China is definitely unique in certain ways, but the other thing about China is that it's not just about international student flows to the US, right? So if you look at students from China, there's been this big increase in most other countries that have a well-developed higher education sector. So the blue line is Australia. The gray line is the UK, the orange line is Canada. Now the scales of these axes are very different. So the US is on the right scale and the other countries are on the left scale. But that's just because the US has a much, much larger higher education sector than these other countries, right? But they're all trending in the same way. Again, telling us that there's something really particular about something's happening in China that's really pushing a lot of students out of China to these other countries that have a well-developed higher education sector. It's not just about US universities demanding more international students, right? So we're trying to now understand what is it that's happening in China that's really driving this big flow of international students to developed countries. And we are going to claim that this Chinese export growth is going to be a major part of the story, right? So the story we're basically going to say is that income growth, so trade-induced income growth in China is what allowed families in China to afford higher education in countries like US, Australia, Canada, and the UK, right? So the export growth was a major driver of economic development in China that allowed families now to be able to afford to go to the US and pay these high tuition rates, right? So that kind of story really fits into two different types of questions, right? So the one type of question is, look, how does economic development affect out migration or the flows of people? And, there's a very rich literature in migration that kind of talks about this. They basically talk about, how development has these ambiguous effects on the decisions to leave where you're from, right? So on the one hand, when your own region becomes richer, so if your own city in China becomes a lot richer, you might now you have the money to actually pay that migration cost and leave, right? So now you have the money, the wherewithal to pay for tuition and living expenses at US universities, right? So you might leave because you can afford to leave, right? On the other hand, if your city in China becomes richer, maybe now they invest in better universities, there are better jobs in that, so you're less likely to leave, right? The opportunity cost of leaving a growing city can be quite high. And so it's somewhat ambiguous what we should expect to happen when your own city becomes richer, right? And that kind of ambiguity is something that a bunch of papers have already discussed, in Mexico, Indonesia, and different parts of the world. So you might expect that better labor and education market opportunities at home might either stem these flow of students abroad, or there might be more out migration, right? So as they can pay, more and more people might leave, right? There's a somewhat related story that the trade people have talked about on the complementarity between trade and migration, and there the story is that, you know, if you can import a good, then you don't really need that skill. You don't need to really attract that skill mix of workers. So for instance, if you can import a car, you don't really need to bring in workers who are good at making cars, for instance. And so there, if you had trade barriers that restricted the import of cars, then you need to, that substitution with migration. But there are possibilities where there is this complementarity going on between trade and migration. So we are going to propose a different channel, and I'll tell you why our channel is very different from what the traditional trade theory really talks about, right? So the main first, sorry, go ahead.
Quick clarification. It seems to me that you are equating this study abroad equal to migration. I understand some Chinese students may eventually settle in the US, but many of them these days will just return to China. So are you trying to say that these Chinese students study in the US, you consider them as kind of migration to the US?
Yeah, so right. So we're using migration, you know, in the kind of the broader sense where we talk, you know, any flow of people, whether it's for marriage or work or studying or whatever. But you're right that more traditionally migration is used to talk about workers. Now, a lot of the students coming to the US, so what we can see in our data is whether they stay on to work for at least 1 year. In our data, at least a lot of them stay on to work for at least 1 year. Now, it could be that a lot of them go back after that. We have some other work where we talk about how changes in the US labor market affect international student enrollment, right? And what we see is that at times of recessions, when US universities actually need more international students, right? There's more demand for international students. The supply of international students actually goes down, that there's fewer applications. So that suggests that a lot of students are coming to the US with the hope of joining the US labor market, right? So it's a pathway to join the US labor market. Now, for a lot of students, just the option value. It's not that they have to join the US labor market, but they like the option that if I go to a good US university, maybe recruiters will come to these universities, recommendation letters, I have made contacts, enlarge my network in the US, and I could have the possibility of getting a job. We think that that's definitely a motivation why students are coming to the US. But they don't have to, right? Yeah.
Can I have a go at this?
Sure.
As well? Sorry. You know, running through all your stories here, I think you're leaving out two elephants in the room, right? That are very special about China. So the first one is the rate at which the Chinese tertiary education system has been able to grow its supply, its capacity to carry all of its domestic students. And there is arguably a period of substantial lag, a period of, as you said, accelerated economic growth post-accession. And so there is a push factor associated with that. But I think the most important elephant in the room that you're leaving out here is that the most of this growth, or very much of the growth in China, has been in the private sector. And if you know any families who are tied to the private sector in China, you know that there is always the specter of being charged with corruption, simply because by our local definitions of corruption, everyone who works in the private sector or invests in the private sector of the Chinese is indeed corrupt, because they have to be corrupt in order to succeed in it. Now, and what that means then is that there is always political risk. If you can make a great deal of money, but there's constant political risk. And what that means is that families, and I'm talking families here, they need to hedge that political risk by ensuring that their kids get some kind of migration status in other countries, so that they can move if they need to. And so what you find, and I think the option value story you tell is similar to this, right? So what you find is the children get sent out whenever they can get into good places, and then they get what immigration status they can get, which means that the family is facilitated to move if they need to, if the corruption case comes around, right? That is, if they fall foul of a very dominant central administration in China. There's always that risk if you're in the private sector.
I think these are great points. So both, we explore the capacity constraints at the local university level a lot more in detail than we do on the possibility of legal persecution. But the important thing of what we're gonna, these are both going to be. I can talk a little bit more in detail when we get to how we identify. Really, some of these are identification-related questions, right? How do we really draw the causal link between Chinese export growth and international student flows, right? And so we're just going to isolate that one link. Now, there are going to be many other factors why international students are coming to the US, and a lot of that could be related to whether their families might fear legal persecution, but we are going to try to isolate this one channel and then see how much that one channel can really explain of the aggregate flows abroad, and it basically explains most of it, right? So that's not to say we can explain the entirety of why people are moving, why students are going from China to the US, but we're going to try to causally really isolate this one channel in our
if I could just come back briefly on that, sure. The worry I have is that if you just set aside China's size for the moment and just say, how does the rate compare with other countries, and then it would seem to me, and I haven't actually done these numbers myself, but that rate would be extraordinarily high. That is that China is a huge exception by international standards, even beyond the fact of its size, and that exceptionality means that you need to be able, in your explanation, to say why it's different from India, that is why it's different from Bangladesh or somewhere like that, right? Why is it that it's such an outlier? And my sense is that the principal driving force is the economic and political system in China. That's what's the outlier.
Right. So if you look at the rates, actually, countries like South Korea, for instance, are much higher in terms of what fraction of their college-age cohorts are studying abroad. Like countries like South Korea are a lot higher than China.
But but controlling for income. Sorry, you have to control.
But the thing is, what I'm saying is, income is the reason really why South Korea is sending more students than China. And then I'm going to say now, well, how important is the income story? So we don't want to control for the thing we're trying to explain here, right? We want to actually understand how important that income channel is. So, and control for everything else instead, right? So that's the nature of the exercise we're trying to do here.
Okay. Please.
Yes, please.
I think very important difference between China and other countries that the control of foreign reserves. You see the sudden jump of international students, even at the beginning of this century, was very slow because simply people didn't have access to foreign currency. And then in the last 10, 15 years, the government encouraged citizens to spend the US dollar. That's why, to some extent, the high rapid growth is going to catch up, because before they 2 or 3 decades in the last century, ordinary Chinese citizens didn't have access to to US dollars. They can't go overseas. That's one point.
Yeah.
The second point
No,
is,
I think that's,
but very quickly, second point relates
yeah.
to Simon's comment on the total student number versus the retention number. If you see the total numbers rapidly rising over time, but if you look at retention, or you use the stay on, the ratio actually very high at the beginning. In recent years, the retention rate is much lower, declining, moving the other way around.
Yeah. So on the first point, actually, you know, and somewhat related to Rod's point in the sense that income, like we're going to say that income is an important channel, but China is still unique. Now, so basically, if India grew as quickly as China, then we might not have the same type of response. And some of it is because, you know, there are different types of economic constraints, including what you could do with US dollars in China in terms of foreign reserves, but also the fact that the entire economic political system is different, which is what Rod was basically pointing out, right, in China. So I think those are important. We will come back to this thing about capital restrictions at some point, but let's get to that in a few more minutes. So the other kind of question we're really trying to ask is, you know, so the first question really talks to the migration literature. The second question is really more about the trade literature, right? So in the US and in many parts of the developing world, including Germany, there is this discussion both in the academic and the policy sphere now on how trade with China has been bad for these countries, right? That it's had pretty negative labor market outcomes for US workers, particularly US manufacturing workers, that there's a claim that it's really destroyed the manufacturing sector in the US, led to huge increases in unemployment in the manufacturing sector, reduced wages, and that has had increasingly other downstream effects on things like mortality rates, right? But that entire conversation, and better evidence that actually led to was a big contributor in the recent US election. So Trump's vote share was very strongly correlated with the China shock, right, in the US. But you know, that entire conversation has focused on the US's goods deficit with China. What that's missed is this entire, you know, the other side of the same coin is that the part of this goods deficit is actually cycling back as a surplus in services. And these are higher education services, right? So basically what's happening, the story we're saying is that the goods deficit with China is what allows Chinese students to come and study in the US. And higher education for the US is a major exporter, right? So the US is a big exporter of higher education services. So the goods deficit is cycling back as this services surplus, right? Now in the trade literature, there is this discussion of how when you have a manufacturing shock like the China shock, right, that the US would really, or any developed country would really switch their production to be more service oriented, right? So basically, if you're importing goods, manufacturing goods, then you instead invest in the IT sector in the US, and that's why Silicon Valley kind of got more resources, and the US became the major exporter of IT, right? Now so that's one way in which comparative advantage really switches how you basically start importing manufacturing goods and you switch to services. But we are proposing a totally new channel, right? The story so far in the trade literature is really about costs, manufacturing costs of both of services and non-service goods, but not really about consumer demand, right? The new channel we are proposing is that when trading with China is actually increase the demand for services, right? It's not that it changed the cost of producing IT. It actually increased the demand for higher education services, right? And that's really what drove how this goods deficit really cycled back into a service surplus. And this is where we're going to have to be important in comparing dollars to dollars to kind of try to answer this. So how much did the $1 increase in the goods deficit cycle back in dollar terms to a services surplus, right? So that's going to then help us answer subsequent questions on the possible trade wars that we're in right now. Okay, so that's kind of what we're trying to do. So how do we do this? So what we're going to basically do is run a regression like where we have on the left-hand side, our dependent variable is going to be the flow, the change in the number of students at the city level. We have, so C is script for city. So what is the increase in the flow of students from a certain city in China, right? And how is that related to what we are going to call a trade shock, right? So the trade-induced growth in that city, right? And that's, again, going to have a C subscript. So all this analysis is going to be at city level, right? So the empirical strategy we're going to use is basically from this entire literature, the same literature that talks about how the imports from China affect US manufacturing. That literature focuses on the US. We're going to use those same instruments and just look at China, right? So the entire literature is focused on what's happening to manufacturing in the US. We're going to instead say, okay, well, now instead of using variation across US commuting zones, let's look at variation across Chinese cities, right?
I've got a question.
And I'll discuss this variation
of yours.
Yeah.
So equation one of yours, I've got a basic question about this. Is there any reason why you focus on students? Why couldn't you write this equation with the left-hand side any other service like software exports, or for that matter, exports of financial assets from the US, exports of US Treasury bills, which is an important way of recycling those trade shocks. In fact, I could imagine a set of equations here, one for each of those things, whereby they exhaustively add up to the trade shock rather than just focusing on one potential route for the recycling and the trade shock. You could have another equation for software exports, exports of US.
So we do that. So we are going to show you that result. We're going to show you what happens to just expenditure on services in general. I mean, the question we were interested in is what's really driving the flow of international students. It's a big important question for US universities, especially, I don't know if you've been following what's happening in the US over the last couple of months, but there have been recent executive orders that have really made it difficult for international students to come to US universities. And so the entire higher education sector is up in arms because they know they're going to lose an important revenue stream. So because of that, we really wanted to focus on this as a dependent variable, but I'll show you some results on other services as well. But this is the question we were most interested in.
Can I chime in on that? I mean, I appreciate Ken's point. I think it's exactly right. My worry is that we need to do some economics here, right? And the economics is really about prices. I mean, so in some sense, the story you want to tell is that the macro developments have led to a relative rise in the price of higher education in China and or a rise relative to the US, right? So, and in fact, in the price of services, in which case, what we should observe is an appreciation of the real exchange rate. That is, the Chinese real exchange rate should appreciate through time, which implies less traded goods tend to get more expensive over time. But when we look at those stats, we don't see it. right? We don't see this spiking in the price in the average service price in China through this period relative to the US.
So a few things, if I may just jump in there. So that's
Sure.
actually, this is exactly the time you do see the appreciation of the rate, but I don't think it's about prices here. I think it's about liquidity constraints. So so Chinese students could not afford to go to the US, right? Now, sure, the returns to a US degree might be high. If they could borrow from someone who could give them a loan to go to the US, then sure, they might be able to, but that credit market is missing. This income
that's not true. Hold on. That isn't true. I mean, you know, the people in families in China collect small amounts across large numbers of related people in order to finance one student going abroad. So I think you'd find there's a literature on that as well. You're quite right, though, that's very difficult to go to a bank and get a loan for Chinese families.
But this getting families together, I haven't heard of it at such a massive scale, you know. We're talking about that's 300,000 students. I'm not sure, sure there
and 1.4 billion people.
That.
Come on, 300,000 students is not many. I mean, you think of the number of people who are engaged in the private sector in China; it's very large. And these people, in general, they're very wealthy. Right? So, I mean, I'm not sure I take that argument. I mean, you can do this. It's just that the problem with an equation like the one you've drawn is that you're leaving out so many things. I guess we don't know what's in your X, but things that are going to influence the relative price of US educational services should appear in
the price of US education services relative to China is irrelevant here only because this is a city level regression. Anything that changes at the country level is controlled for. Anything that changes at the time level is controlled for. The only thing you need to think about is if I compare two cities, one city has a big trade shock in China and one city doesn't have a trade shock, right? Which city sends more international students, right? So that's why the C subscript is really quite important. So let me get to that, and maybe we can come back to this.
Okay.
So basically, what we're essentially combining is both the time series variation and the cross-sectional variation. Here is that there was a change in the tariff uncertainty after China joins the WTO. So now Chinese manufacturers knew they could really invest in textiles and the other things that they wanted to invest in because they knew that they were protected with these lower tariffs, and they could. There was a big increase in growth as a result of that. And then the cross-sectional variation, which means the variation across different cities, where certain cities, so for instance, the textile manufacturing cities are the ones that will grow really quickly. And then those are the cities that will end up sending students abroad. That's essentially the variation we're going to use, right? So what do we find? We find that cities that grew more quickly had a much bigger flow of students to the US. And we basically, these impacts are really concentrated on the traditionally not funded students. So students that, well, we can see how much funding they get, but we'll also show you that that the students that are, there's an increase in students at the undergraduate and master's level, and they're basically, the Chinese families are paying for this entirety of this education. You don't see an increase in doctorate education that's correlated with the straight shock, and we think that's because, well, doctorate education is in the US is funded by the universities. You see that these students are basically not getting scholarships. So money is really salient here. The fact that we think that a lot of this is essentially because now students have the money to kind of pay for this education, right? And we really go to a bunch of these mechanisms, right, that we try to unpack bit by bit. the main thing we really find is something like the growth in housing income and growth in housing wealth in these cities. So there's a big appreciation of housing wealth in these cities that really is, then we think, major driver of how families can afford to pay for these tuition. We look at a bunch of other channels, including changes in the information, return to different types of education. I can't remember who raised the question of the capacity constraints of Chinese universities, but we kind of really examine a bunch of different channels as well. But we don't find much evidence with these other channels. The main thing that seems to be driving this is the concurrent increase in housing wealth in these. And then we can do an exercise where we say, okay, what if we basically, if we look to the current trade wars, what would be the consequence of these current trade wars, right? That would mean that these the Chinese exports would fall, but that means the US higher education exports would fall as well, right? So the trade wars would actually reduce education service exports for the US by about 3%. And for China in particular, for 3%, that's for all higher education exports, but 8% particularly because of China, right? And this is only looking at what happens to US tuition revenues, whereas there are going to be a lot of other general equilibrium effects in the local economy that we're actually studying right now in a separate paper. So what do we mean by these GE effects? Well, Chinese students are not just spending money in university, they're also spending money in housing around the university, buying cars, buying clothes, food, etc. So they're affecting the entire local economy now, right? So there are going to be other consequences because of these trade war restrictions. Okay, so let's talk about.
Gaurav, if I could just interrupt for a moment. Did you consider pollution as a potential mechanism? I don't know if you could find data going back that far, but you know, obviously it's correlated with growth and these sorts of things. So. I do hear stories about students leaving their home countries on the basis, particularly recently, that the pollution levels have just gotten so high.
Yeah, that's a good question, because it could be something that's correlated with the trade shock, right? So that's exactly the type of thing that we want to be worried about, right? Because that's exactly the type. So anything that varies in strong conjunction with the trade-induced growth is something that you want to about, right? And so that's something we haven't looked at actually. So that's something we should look at, and could be, just the cities that had a lot of trade-induced growth could be a lot more polluted, and that might be a reason why they might want to leave. So that's something we should look into. We can that, especially leveraging how the recent restrictions in China, where they cap pollution level in different cities, are actually leveraging that other variation we can try to do. Okay, so what are the empirical strategies that we use? So what we do is, well, first so in the US, you have this Freedom of Information Act, where you can essentially ask the US government for all kinds of data. So what we do is I submitted this application in 2013 when I was in graduate school still, asking the US government for data on all the international students in the US, including exactly the address they're coming from, where they're studying, what they're studying, when they started, when they're ended, all the different sources of funding, the amount of funding. This is not just for Chinese students. I found myself the data. You could see, it's for all students in the US, right? So that's pretty rich data. And on the trade shock side, what we have is, again, pretty interesting data, which is customs, the Chinese customs trade data, which tells you at the city level, right, what is being produced and what is being exported. So it's saying Beijing is producing so much in textiles, so much in automobiles, so much in software, and it's exporting so much in textiles to Vietnam. It's exporting so much in automobiles to Australia. Like, it's very detailed level data in that way, right? And then we put together a few other data sets for the mechanisms. but I won't spend too much time on that. Okay, how do we actually create this measure of trade shock, right? This, for those of you who are familiar with the trade literature, you would have seen this many, many times because the US trade literature kind of uses this for all their analysis. But what happens is when China joins the WTO in 2001, what happened automatically was it was conferred what they call permanent normal trade relation tariffs. So normal trade relation tariffs are, just think of it, these are lower tariffs, right? Now, earlier, to get the NTR tariffs, for instance, to export to the US, the US Congress had to approve it every year. So every year the Congress would meet and say, oh, this year would we allow China to have these NTR tariff rates when they're exporting to the US. And that created a lot of uncertainty, right? And each product had a different tariff rate, right? So what you can do is you can create what the literature calls an NTR gap, right? Certain products, right, the gap between the NTR tariff and the non-NTR tariff was really big, right? Like in textiles, but at certain products, it was really small, right? So what that does is when you join the WTO, that means that now you know for sure the textile tariffs are going to be very low for a long period of time, as long as, so there's more certainty, so you can really invest in your textile manufacturing sector, right? So there's going to be a bigger impact on the textile sector than there is on the other sectors, for instance, right? But we have to take this product level NTR gap and make it a city level measure, remember? Because we're trying to compare cities that had a bigger trade shock to cities that had a smaller trade shock. And the way we do that is we scale each city's product, right, by, well, first we do it by employment shares, we do it by production shares, or we do it by baseline export shares in the years before they joined the WTO. So we use 1997 because that's the first year of our trade data. But basically saying that if a lot of the city was involved in textiles, then a change in the textile tariff will make that city grow faster, right? To understand, these are
Gaurav,
the different, yeah, go ahead.
can you go back to the previous slide?
Yes.
So this is very interesting. So the way I understand is that your trade gap, the NTR gap or the trade shock that you're estimating is very US specific, right? Because the gap here is what the rates would have been without WTO as opposed to what they were when China joined WTO. So this is a very US specific shock, which helps your story, except I just wanted to understand, would it be possible that in some certain categories, this gap in general would be large, no matter the country, for Australia, for UK, maybe automobile, say for example. And if that is the case, then the trade shock that you're measuring probably would be a general shock, not a US specific shock, because my understanding is you're trying to estimate US specific elasticities, not general, right?
Yeah, so I think that's a great question. Now, actually what we do find is it's a general shock. And not just what we find, but the trade literature has already shown this in some ways. And I mean, the literature argues basically that, when the US, this kind of US specific shock allowed the textile firms really make big investments in textile manufacturing, but that meant that now that they spend so much money on building big textile factories, they also could export to Germany and the UK and Australia, right? Yeah. When we do the elasticities, what we care about is the export, the value of the exports to the US, not the trade shock measure. The trade shock measure, sure, is going to be the first stage that identifies that how the value of exports changes to the US. But the elasticity is still going to be driven by the value of the export. So there's two concepts here, right? The trade shock itself, at the end of the day, happens to be actually a general trade shock, not a US specific trade shock. but the value of the exports we can separate out by the different countries that they're exporting to, because we have that data. That's a great question.
Can I just make a comment on that?
Yeah.
You've got to be careful here. I mean, I don't think you want to make the same mistake that Donald Trump makes, right? Thinking that bilateral balances or bilateral imbalances are significant. Right? My sense is that bilateral imbalances, and the bilateral imbalance with the US is not significant at all. But students, I think you're right, that when students' income rises in these cities, families can afford to send their kids to school. And they're going to send them to good universities. Where are the good universities? Well, most of the high-ranked universities are in the US, so they send them there, right? I mean, I don't think we need a bilateral imbalance story with the US.
You're absolutely right. Yeah, we don't need the bilateral. No, I'm sorry if I gave any implication that we were giving we were saying that it has anything to do with trade balances. There's nothing to do with trade balances. The story that you outlined is exactly the story that we are actually trying to say, that it's about income growth, and the US is the best universities, or the most number of universities. And so, but we still care about a relationship, an elasticity between the export of goods from China and the import of higher education services into China, right? So because that'll then at least give us this kind of dollar-to-dollar comparison, right? That I think Kenneth was asking about earlier, right? So that's just it's important to kind of know that in some ways. Okay, so this is just a description of kind of the different, so certain products, so these are different, each bar is a different product. So certain products had a much bigger decrease in their tariffs, and certain other products had a much smaller decrease in their tariffs. So there's a lot of variation by the different products. And then when you aggregate up to the geographic levels, you kind of see that a lot of the big trade shocks were in regions, kind of over here in the south and the kind of the east. So when you, this is just the geographic variation that we're going to be using given our data. Right? Okay, so when we're doing an exercise like this, we want to do also some kind of falsification tests, right? So first, what we do is we have this trade shock measure, right? This PNTR measure that I defined for you here, which is just the city level. It's a weighted sum of the industry employment shares weighted by the change in the tariff rate. So, right? So certain cities, for instance, over here, maybe certain cities are big textile producing cities, and so they had a much bigger trade shock, and certain other cities might have been automobile producing cities, and they had a much smaller trade shock, and so they're not going to grow as quickly, right? But we want to do this kind of falsification. We look at we look at the pre-period, right? So we say before China joined the WTO, right? What was happening in the cities that had a positive trade shock, and compared them to cities that had a much smaller trade shock, right? And you see it's really not related to much else in the education sector in China at that time. We do a bunch of other checks. But basically that shock is not really related to what was happening to the number of college students in those cities, or the number of colleges, cities, the number of middle school students in those cities. It's also not even related to what was happening to exports from those cities before China joins the WTO. So in the years leading up to China joining the WTO, also it was really not related to exports. But after China joins the WTO, right, there's a big increase, there's a big positive association between exports. That's shown in this picture. There's a big positive association with the trade shock and the value of exports from those cities, right? So this is just the falsification. Yeah, sure.
Can I ask a quick question about this? So
yeah,
entering the export market will have spillover in terms of the returns to learning English, for example. I mean, you're producing goods for the international market, you need to be able to interact with them. And also in terms of how much of a barrier language continues to be if you decide to go outside to study. So how does that affect the
Yeah.
mechanism story? Because that'll generate a supply
Yeah.
side factor, right?
That's a great question. And we're going to come back to that when we explore the mechanisms. So we kind of try to define it as there's a change in the return to getting a US degree, and the change also in the information now that you have about US markets, right? So we're going to try to explore both of those when we explore the mechanisms. Okay, so what is kind of results here? So so this is just one of the plots we show, but basically that same, these are, each dot is a city again, right? So yeah, so the PNTR gap, so this is, if you go more to the right of the graph, it's a more positive trade shock, is associated with more growth of students from these cities. So it raises student out-migration by quite a bit. Now the trade shock explains about 25% of the total increase in international students coming to the US, right? So there's still a bunch that's unexplained, including possibly things like legal persecution and capital flow restrictions, etc. But the trade shock explains is quite a meaningful fraction of the flows between China and the US, right? We do a bunch of robustness checks. So there's a kind of Beijing and Shanghai basically are up here. If you throw them out, the relationship kind of becomes a little stronger, if anything. We try a few other robustness checks. We take all the large cities or any capitals of the provinces. In the trade literature, there's a big discussion of the different types of controls they want us to use, things like the export licenses, different types of tariffs that different trade papers have talked about. And then there are other empirical robustness checks that recent papers that discuss these shift share instruments have talked about that I won't go into right now. And then we actually use a few other instruments to kind of replicate the same set of results. One is something called the world import demand. So what is a world import demand? It's just the demand for these products that have nothing to do with tariffs. It's just the demand for these products from other countries. So it's Germany, UK, Australia suddenly have a lot of demand for textiles. Then the textile manufacturing cities in China will grow faster, right? Whereas say the demand in Italy and Spain for automobiles have fallen. And so then the automobile manufacturing cities in China will not grow as fast, right? So that's a different type of instrument. And we use that. And then we use a third instrument, really the expiration of the multi-fiber agreement quotas that again is something that a lot of trade economists have looked at. Again, we get pretty similar results no matter what kind of
Gaurav,
yeah.
Do you mind if I jump in here?
Sure.
So you're majoring these trade shock in Chinese cities.
Mm-hmm.
So I wonder how this big, massive internal migration in China would affect your results, or at least interpretation of the result. So, we know there's a huge, massive internal migration in China, and especially the coastal area, coastal cities. Most of the workers there, they are not originally from there. Chances are they have their kids back at home, and then they make the money in the big city and send money back home. But you're capturing the student coming from their original city, but not where their parents working, right?
That's right. So that's right. So what we have, and actually to say more to your point, we actually do find that there is internal migration in China, it correlated with this trade shock, right? What we have really is that what we basically have is what we call an intent to treat, right? So this is your hukou city, or your basically in the application, the data that we have is for your permanent residence, right? So we know which city that you're permanently the student resides in, right? Which is what you meant as the city that the children have been left behind in, right? But your parents could go elsewhere and work in a different city. And that will kind of mitigate, it will kind of bias you against finding big effects, right? It's an intent to treat here, right? So it's basically your your original city is the relationship we are using. We don't want to use where the city that your parents are working in. That is endogenous, right? That is a choice your parents made. And it could be, for instance, maybe the more well-connected people are the ones that are migrating to those cities, right? And that's going to end up biasing. There's going to be selection issues there. So you want to use your hukou city, right? And so that's why we kind of do the analysis at that level, right?
So do you have any sense, like, do you tend to see the bigger trade shock along those coastal cities?
Yeah,
compared to the inner cities?
And that's also where there was more in-migration as well. Yeah, that's right.
Okay, all right.
Yeah. Okay, so we do a bunch of different robustness checks. We control for different, all the trade people have talked about. We dropped the 4 largest cities. I won't go into the details because I want to get to the mechanisms here, right? So the main thing that we when we came in, we were somewhat agnostic as to what we would think of the mechanisms, but what seemed to really be driving, what we seemed to be finding strong evidence for was this wealth channel. It would lead, there was this increase in wealth that would lead to this general reallocation of consumption towards services. And this is something that I think Kenneth also brought up, saying that it should be all kinds of services, right? Including IT services, etc., right? And we'll show you some evidence of that as well. We find that there's this big increase in income and wealth. Don't find much evidence supporting the changes in the returns to education or information. But let me tell you how we explore these mechanisms, right? But before I go into that, I want to talk a little bit about the second point that many of you are already familiar with, right? That there's this paper by Chen et al. That talks really about how the large increases in wealth in China are likely going to be manifested particularly in the real estate sector, right? And so what we should expect to see then is the changes in really the housing wealth in these cities. And so that's kind of something we see here. I'm going to speed up a little bit over these slides because I want to get to something else also. But what you really see is that there was an increase really in the real estate and self-business income in cities that were more exposed to trade liberalization, right? The share of how much people were paying for rent in these cities went up, property value, these are all strong effects. Income from the own businesses also went up, so there was an increase not just in housing and property, but also just small businesses as well, in real estate businesses. And then, for instance, this is just, we aggregated the different types of services, but this is just, this is kind of getting to your point on what were people spending money on? They're spending more money on services. And there's a literature on the income elasticity of services. So as people get richer, they spend more and more on service products. And you kind of see that as well here. And we think that's part of what's going on here, right? For the returns to education, what really is important, well, firstly, there's a few different types of returns to education. One is just, does it make more sense to even just get a college degree, right? And what you essentially see is that the trade shock, what it did was it actually lowered the returns to education. Why did that happen? So what the trade shock, what it did was it reduced tariffs more so for low-skilled products than for high-skilled products, right? So what you can do is you can look at the skill mix of these products at baseline and then see really what happened to these, what happened to the increase as a function of these trade shocks. So what these trade shocks did was it increased exports and increased employment in what were traditionally low-skilled products, right? So if anything, what it would do is it would reduce the returns to education. And we kind of replicate this other paper by Lee that kind of makes that's why at certain levels of education, the educational attainment in China actually went down using a similar instrument, went down because of these trade shocks. But the other kind of thing that we need to worry about is the capacity constraints in Chinese universities, right? I think Rod raised this point about that there's not, Chinese universities now, they're investing in the 211 project universities or the 985 project universities, but earlier there were capacity constraints, right? If you don't get into the Peking or Tsinghua, then you might think that, oh, I may as well go to Michigan State University or Texas A&M, right? But again, the capacity constraints are not binding, and we think that's essentially because of the fact that that it doesn't matter which city you're really coming from as such, right? You could come from a different city and still go to Peking University, right? So it's not something about your local university as such that's kind of really driving these effects here. So we don't think it's about the capacity constraint. We don't think it's about the return to education. What about information? What about knowledge about the US in particular? The interesting thing, what we can do is that we can separate out the part of the instrument that's really driving exports to the US versus the part of the instrument that's driving exports elsewhere, right? So remember I said that this, you think of this as an aggregate really trade shock. What you really find is that they have the same effect. So if it was information, then the part of the exports that are driven really by the connections to the US, those are the types of exports that should really be driving the information channel. And those are the places where you should really be seeing changes in international student flows. If the information channel was important, those are the cities from where you'll be seeing more international student flows. Instead, if you look at, you look at now the China's joined the WTO and they've invested in textiles or whatever, and they're kind of now going, these exports are going to non-US destinations. You see those cities as well are sending a lot of international students abroad, right? So we don't think it's anything about information in particular to the US specifically, right? So we don't seem to find that evidence. Okay, so the next thing I really wanted to talk really about is the kind of the composition. What types of students are going? What are they doing there? And a part of that is going to really be important from the US's point of view, right? Because it's going to affect the distributional consequences in the US, right? Are they going to Midwestern states where there was a big decline in manufacturing employment? Or are they going to New York and LA which are doing pretty well already, right? So we want to look at differences like that, but also what are they studying and what level are they studying at? So let's talk a little bit about this. So firstly, when you divide the students by the different types of students, what you really see is that the big increase is really just driven by students that have no funding from the university. So all these students are just paying for their own education, right? They get no funding at all from the university. This has funding is even a little bit of, even if there's like $1, we classify those students as they have funding. And even there, if we have this very kind of conservative estimate, we see that the big increase in students is not being driven by students who get funding from the universities, right? So we think money is really an important mechanism here because you can see that all these students are just paying for themselves. Students who get scholarships are not much more likely to be coming from places that had a positive trade shock, right? When you look at the level of study, it kind of tells you a similar story. So courses like the bachelor's degrees and master's degrees, where students basically don't get funding in the US, those are the levels of study where you see this big flow of students. On the other hand, doctorate degrees, which are funded in the US, you see basically no relationship, right? So doctorate degrees, there's no change in doctorate. Well, there is an increase in overall doctorate degrees being granted from China, but it's not correlated to the trade shock in any way, right? Whereas bachelor's degrees and master's degrees are strongly correlated to the trade shock, right? The field of study, again, there is mostly driven by business degrees. A lot of students are coming for business degrees. I want to move on to, okay, the university quality. It was kind of divided across the different quartiles of the university quality. This is important. This is about US commuting zones. I want to spend a minute or two talking about this. So what we do here is look at where in the US these students are going. Okay, are they going, like I said, to these Midwestern states where there's been a big decline in employment and incomes, where the Rust Belt had, you know, so or are they going to other parts of the country, right? So what we do is we divide each commuting zone in the US into whether they're you know, high human capital, which are mostly during the, along the coasts, to low human capital, which are in the South and the Midwest, for instance, right? And you kind of see that the students are going kind of all over the country, right? They are going, sure, they are going to the coast, they're going to the New Yorks and the LAs, but they're also going to Purdue and Michigan State and Penn State that are in the Rust Belt. And that's quite important because—
University of Chicago.
Yeah, the University of Chicago, yeah.
Thank you.
And that's quite important because the trade literature, you know, the trade literature has talked a lot about how there are these unequal consequences for the US, right? That the China shock really hurt the manufacturing sector in the US. And what that ended up doing was it led to a big decline in the Rust Belt. It hurt the Midwest a lot, right? On the other hand, the IT sector was booming. Wall Street was, well, doing well and going down sometimes, but you know, the coasts were doing relatively better, right? So the trade literature talks about how trade really exacerbated regional inequalities in the US. What we're showing is that students are going everywhere, right? So they're not exacerbating those inequalities, right? In any way. If anything, now they are an important source of revenues in the Rust Belt, right? So I went to the University of Michigan, but in Michigan State, just down the road, well, not down the road, but a few hours away, there was a lot of discussion on how the entire East Lansing economy was now really dependent on international students, right? International students are not just revenue from Michigan State University, they are also propping up the housing market at Michigan, in East Lansing. They're also propping up, they're buying cars, they're buying all kinds of things. The entire local economy is very dependent on income.
They also buy gas station.
They also buy gas stations. Okay, that's good to know. I didn't know that. So it really helps the local economy in the Rust Belt where the local economy has been declining, right? So it's speaking to that literature on inequality, regional inequality in the US, right?
Do you have information about the distribution of Chinese communities in the US?
Yeah, we can get that.
Any correlation between Chinese student flow and the community population size?
So we don't see that. So if you look at the distribution of Chinese communities in the US, you see them, a lot of them concentrated along the West Coast, and then in pockets along certain pockets along the East Coast, right? Whereas we're seeing this kind of spread, like you know, a lot of increase also in places like in the Midwest, like Purdue, but also in the South, like Texas A&M, right? So it's not that correlated with baseline where the Chinese communities are, but that's, I mean, there is a big increase in California as well, but it's just, you know, we see that increase is also similar to the increases in the Midwest, for instance. Okay. So kind of what are the implications of this? So now that we have this relationship, right, we can kind of do these exercises. So where we can look at we can translate our estimates into dollar amounts and then talk really about what that means for the current state of trade wars that we're in currently between the US and China, right? So we know, for instance, from our estimates that what the tariff changes in tariffs, how that affects student flows, and then we can use that elasticity essentially to kind of compare it to dollar amount. So we know what the average tuition levels are at these universities, at about $40,000 per year. And we can then, when we translate that, we see that enrollment would fall by a certain amount. And that then, the current trade war is estimated just in affecting US higher education tuition revenues by about $1.15 billion. But that's just the tuition revenues. Like I said, a lot of the increase in incomes in the US are how they affect the local economy, and we're not even calculating that, right? So even if you just look at just simple what is the lost tuition revenue to the US higher education sector, the trade wars, the current trade wars are going to cost the US about $1.15 billion, right?
That number seems pretty modest if we're talking about all US universities. Let's take an average university. My guess is that the US has got an average annual budget of between $0.5 and $1 billion. Maybe a little bit more. Okay, let's say a couple of $100 million for a reasonable sized university. A couple of $100 million? You agree with that?
Yeah. So I agree that it is.
You know, compare a couple of $100 million multiplied by how many US universities are we talking about?
Yeah. No, I agree. So I agree that this is just the flow, right? So this is just the lost tuition revenue. I agree it's a modest number, but what we might, so this is now it's modest in certain ways, in the sense that the universities are definitely worried. So I don't know if you know, but like University of Illinois Urbana-Champaign recently got an insurance company to write them a contract saying that these trade wars are going to cost us a lot of money, write us an insurance claim, right? They're worried enough to do things like that. They're worried enough to lobby the Congress. They're worried enough to disinvite the Dalai Lama from actually giving a commencement address. So they're worried by these things, right? But that's still small compared to the local economy effect. Our estimates are closer to $40 billion when you incorporate what happens more widely in the local economy. But but those are based on a lot of guesswork, so we don't want to go into that. So yeah.
You could also comment on tourism and link it with students, right? Student parents, relatives tend to visit the place that the students are.
Yeah, so again, we could do, I think it would be nice to do those exercises. There, again, we're going into a little more guesswork as to, try to come up, from a simple accounting point of view, I still think it's a very valuable exercise to do. I mean, it's simple back of the envelope calculations, but it would need us to make a lot more assumptions to kind of get at those numbers.
My point doesn't relate to the general equilibrium effects. It doesn't relate to the tourism effects. It relates to the size of the university, plain and simple. 1 billion in the US university system, it's a small number.
Yeah, I agree. 1 billion, I agree that it is a small number. It's about 8%. So the number of students that are going down from China are about 8% of the students that are coming, and which is just 3% of the total international student flows, right? But the tariffs, we're doing it by what's happening in the current tariffs. If you stopped all trade altogether with China, then you'd get a much bigger effect. If there are more political upheavals with China, you accuse them of other things, you'd have much bigger effects. What we're doing here is right now just taking the current changes in tariffs in this last year and saying, okay, what is the implication of that, right? That's not the same as saying, oh, what is the total contribution of Chinese students, right? If anything, this is only, 8% of the contribution of Chinese students, right?
Right,
So,
since we are running out
Yeah,
of time, can
I
we
take
hold on
your
to the
point.
questions?
Yeah.
okay,
Okay.
sorry, yeah,
take your
sorry.
point.
Yeah, so no, I just wanted to, kind of wrap up here with one last point, which is the point right at the end. Like, what is the revenue actually used for? So we have another paper which basically shows that the revenue that these US universities are getting from international students is what is allowing the universities to keep tuition levels low for local students and to not have to cut expenditures on things like research and staff and faculty, right? So universities like Central Michigan University that could not attract international students from China, they actually have been raising local tuition levels, and they've been cutting expenditures on research and staffing, for instance, right? So the international student flows have really helped these universities maintain quality, but also keep the universities open for local students, like make it more accessible for local students. And one of my other co-authors really shows how, more in detail about how this works, is how international students, revenue from international students are being used to cross-subsidize local students, right? So international students pay three times what a local student would pay, or sometimes 4 times, well, more than 4 times what a local student would pay. And so there's this cross-subsidization going on, which is really important for making sure that local students also have access to these universities. So I just wanted to wrap up with that thought. So I'm going to stop there since I'm way over time.
All right, no worries. Okay, all right. So I'll have to end it here. If you want to stay back and ask Gaurav questions, feel free to do that. So yeah, please join me in thanking Gaurav. Interesting talk, Gaurav, and hopefully next time you'll do it in person here in Perth.
Thanks a lot. Yeah, thanks for having me. These were really great comments.
Thank you. Thank you, everyone.
Thanks very much, Gaurav.
Thanks.
Thank you. Bye.
Bye.
Bye.